Well, hi everyone. Andrew Page here from Strawman.com. I'm joined by Matt Joass from Maven Funds Management. How are you going, Matt?
Very well, Andrew. Thanks. Always good to chat.
Yeah, so the setup here is we were just having a Zoom chat. We haven't caught up for a while. Certainly haven't caught up face to face, in person for a little while.
Definitely not.
And we were just having an interesting chat, and we thought actually we should probably record this. It gives us a bit of content and sort of
Yeah.
something to, I guess, a forum to share our thoughts with everyone out there in the finance world. So here we are.
Here we are.
and I guess we started obviously as I guess is everyone's talking about right now, this whole COVID-19 situation and what that's done to markets. So maybe we'll just rewind a little bit there, and if I could just get your thoughts again on really how you see the last 3 months, how that's played out, and perhaps how you sort of see things going from here.
Yeah, absolutely. So big topic. I think the first thing is it's been kind of a roller coaster where the market's been way too complacent and panic, and maybe it's complacent again in some ways. But this is a very unprecedented event, which a lot of if you go to Livewire or anything or Twitter or Strawman, I'm sure everyone's saying the exact same thing there. But what was really unprecedented was a complete stop nature. And so I was kind of looking at this, kind of late Feb, just as it was before it was turning, I guess, around that time. And you just kind of came to the realization the stoppages that happened in China at that point, it was a complete stop of the economy. And that isn't something that we see ever, even in war, right? Like during war times, economies don't just stop. They keep producing it probably as much as they can, probably tanks and bombs instead of other useful things, but they don't stop like that. And we haven't really ever seen that before. Even go back to 1918 with the Spanish flu, the economy didn't stop. Just a lot of people died. In fact, it was covered up, and they kind of pushed through because of the war, so that they didn't admit it was happening. And so now we've seen something very different. And I think that was largely unavoidable. I don't think it was just the government decision. Obviously, some governments were more forward-thinking. Australia and New Zealand way ahead of the pack. We got to see other people go first, so we had some help, but the outcomes are radically different. But even if you don't do that, I think you have that stoppage anyway, because the world's so connected now with social media and whatever else. If you see people dropping dead in the street and, the tragic that was happening in China, you're just not going to be going out. And so that's what you're seeing around the world, whether you have kind of government-led or not, there is this complete stoppage in activity. And it's a very different thing to kind of get your head around. And I think that's where you really need to think like a few levels deep about what's going to happen, because if you make the wrong assumptions, you can completely miss something. And so, yeah, I guess what I'd seen was market's been way too complacent, like very, very bullish, up to like the highs were at like February 22nd or something. China had already been completely shut down for a long time. And it was 23rd and 4th weekend when we got that kind of outbreak into Italy and elsewhere. And it's just surprised that it took a while for that to kind of catch on. And then people obviously had a bit of a panic. And that panic was somewhat justified because the whole foundation, it was that kind of foundational cataclysmic type event where everyone was defaulting and panicking at the same time to an extent where it starts becoming real. Like it's not just a share market thing, I guess is what I'm saying. There was a risk that companies just couldn't refinance, and particularly in the US, there's a lot of high yield debt. And we had the Fed come in the US and just kind of launch QE infinity, which is kind of an amazing term like to hear, where they basically just say we will print as much money as necessary to restore order in the markets, and even doing things they've never done before. So I think what happened with 2008-9, all the stuff that we thought wasn't possible became possible, and they just, the moment that you had this is an extremely fast reaction. We've also seen the biggest wave of fiscal stimulus the world's ever seen, like on a scale huge, bigger than World War II even, and compressed into a shorter timeline. Yeah. So you've got those two different forces.
You're also forgetting negative oil prices sort of came along at some point as well. So speaking of unprecedented, just amazing.
Yeah, someone said that was a crazy, March was a crazy century in the markets. Like it was just so much stuff happened. Negative oil prices. And again, that was also part of, there's so many moving pieces, because that was kind of this kind of metagame, it seemed like, where the Saudis engineered it as basically there's one take where they actually sent in March millions of barrels of oil to Oklahoma, like exported them deliberately more than needed so that all the capacity would be full, so that when this crunch hit, there would be no capacity for that particular price, so that you get negative oil prices where people have to be paid to take oil because there's no storage. it's just like there's so many levels to this that it's crazy to think through. And I think, yeah, and so we've now seen it kind of everything start settling down. Now we've got this kind of decoupling where a lot of the real economy is still struggling, but markets are doing well. Some of that again is justified because markets should look through. I think you wrote about this super early in the crisis. We should be able to look through if it is a blip. But I think in some parts of the world, it's not. In some parts, maybe it is. So Australia and New Zealand handled it super well. New Zealand now has no new cases. I think New South Wales kind of, some days it has no new cases, some days it has a couple. I mean, a very good chance we effectively eradicate it in both countries very soon. Like it'll happen within weeks if we do. And then, life just goes not straight back to normal, but so much faster than otherwise. Like you have a big party. I'm looking forward to it. I hope there's a big party here. There's still a lot of
social contact would be nice.
Yeah, exactly. So there's still a lot of wreckage to work through for sure. Like a lot of people lost their jobs. A lot of, my neighbor lost both of her jobs in tourism. One of my best mates lost his job. There's still a lot to work through there. But if we can get back on track to normality much sooner, aside from international tourism, then I think that that'll be a really strong position. So yeah, it's a pretty, I think it varies a lot by country, varies by what company you're looking at, and you just need to get really specific into it. How have you seen it? How have you seen it at Strawman, man? You've got a pretty good view, I guess, of everyone's take on the market as well. I'm interested in what you've kind of seen on Strawman.
Yeah, it's been really bizarre. I think to even backtrack before then, a couple of really important lessons were sort of reiterated to me. And the first is just the unpredictability of the universe and life and everything. I mean, this was on no one's radar 6 months ago, and then it shows you how black swan type events can happen and how radical and how quickly things can evolve. I mean, there was just day to day things were changing in a massive way. But then also you had this lesson in the futility of what Howard Marks might call first order thinking. There were certain events that happened where your initial reaction might say, well, given this, then that. And it just didn't happen in so many different ways. And we're going to run out of time going through all of the examples. But, for example, we saw what happened with the Ruby Princess and cruise ships. And yet today we've seen a huge amount of forward bookings in that sector. I mean, who would have predicted that? You've had companies like Afterpay, which dropped from top to bottom like 75%. This isn't a $10 million microcap company. This is however many billion-dollar top ASX 100 stock. It dropped that much. And then today, as we're having this conversation, it's like within spitting distance of a new record high. A credit company basically super exposed to retail. And it shows to me how A, surprising things can be, but B, how even if I was to go in a time machine back to January and say, hey, Matt, here's some things that are going to happen, you would never, I don't think, forecast how things work, like on a specific basis, how things have played out. So I'm actually mindful of that today going forward. So here we are, mid kind of May, and this story has got a long way to play out. You're right, we've handled it incredibly well. I think Australia and the US had our first case around about the same time, and we've seen
that's crazy to think.
Bifurcated massively, and we still don't have a cure or a great treatment. So things. I think it's just really stupid for anyone to come out with very hyper-specific forecasts at any time, but especially at this time. So I'm kind of reminded of all of that. And when this thing first sort of became much more real, I suppose, in February and March, one of the things that I was sort of talking a bit about and writing about was this idea of just survivorship and just looking at companies that are very robust. I mean, we don't know how things are going to play out. But if I can just stick to the very high level, big stuff, is this got a strong balance sheet? Is this a company that's going to be around in 5 years' time? And is it going to be a larger, more profitable company at that point in time? I think if you get that part right, a lot of the smaller things you're not going to have to worry about them as much. And I still think that's true today.
Yeah, I think you nailed it with the not trying to think about there being a definite future, because I think that's like one of the first follies of forecasting, is thinking that you're trying to predict an event, because that's not how the future works. Like, it's probabilistic. So you should be thinking, what are my like ranges of outcomes and how likely or unlikely are they? Because it's not just that it's hard to predict a specific thing. It's like the complete opposite of what you should be doing, right? So you should be thinking like, how likely is it that a vaccine's developed by 2021 or a bit later? What are the different paths to get there? And then you think, as you're saying, thinking about how companies can handle that so that they, I guess so you want them to be able to handle as wide a range of like likely outcomes. There's always something, an asteroid strike on the headquarters that they probably can't handle, but you want to be able to handle as wide as possible, I think, at least. So I think it's been an interesting one. I think you want to think about how, I think that this has shown societies, countries, and companies. It kind of showed who was prepared and who wasn't. Not for this specifically, but it kind of exposed anything that wasn't, locked down in tip-top shape. If you didn't have a good way to, distribute money to the people in your country, or to shore up, if you don't have a good public health system, that's probably going to be something that's unfortunately exposed by this. So,
things were already broken in a lot of areas. You just weren't obvious and noticed. And this event kind of reveals it. Another really great quote, and I'm going to muck it up, but that I heard on another podcast recently, was it's not so much about trying to predict the future, but being one of the first people to sort of recognize where we're at now. And it was amazing when things sort of broke. So I think it's a classic mistake for so many investors is that we look for the market as guidance as to what to do. And you sort of hear these events and you think something will happen and it doesn't. And you start letting it guide you and reacting to it. And it's just a huge amount of problems. And there are some things I think that happened that, again, no one could have predicted this exact order of events and the severity and all of that kind of stuff. But we could have known very early on that this was going to be bad. And it was, and it was also going to be something that wasn't equally bad for all of business and different sectors. I mean, we've seen some companies actually benefit from this, and there's no way I'm going to let you go without talking about PushPay later on, which is a great example of that. And yet, you look at Qantas and Virgin in particular, obviously, but a lot of retail, a lot of travel-related stocks, and it's just it's a tale of many different sectors there as well. So. Just fascinating.
No, I agree. So I should have touched on that. I completely agree. Some people call it like now casting, or just like observing the world as it is instead of as you want it to be. I think it should be. There's another great line from VC investing, which I'm sure you know very well, which is that the future's already here. It's just not evenly distributed yet. Yes, so I think that's something that you should that we should think about a lot, both for COVID-19 and anything really. Is like there's little breadcrumbs of showing what the world's going to be like in the future. And I think if you can tap into those and find those streams of whether it's analysis, there's certain people on Twitter that were talking, with a lot of really good analysis on what was happening with COVID very early. If you can tap into some of that, or just seeing how the world is. So talking to real people, getting outside the office, obviously harder to do physically these days, but getting outside of your bubble, I guess, and then talking to people and understanding, what is seeing more demand. Is your assumption correct? And just being observing. Like there's a really good story from Jim Rogers, who'd made hundreds of millions, if not billions, maybe billions. He was formerly investing with George Soros, and he had a story where he noticed that during one of the Arab-Israeli wars that the Israelis were able to completely wipe out this other air force, and just thought it was really odd, and then kind of dug into it, and that just noticing that little thing that was odd led him to dig into it and find that there was this new technology coming with aerospace, and he basically made like 50% return, or 50x on this portfolio of companies that he bought as a result, not even just one. And I think that just comes from observing the world, noticing little things that are different, trying to pick that rather than trying to have some grand plan that you see execute as the way to go.
And the related to that is also, if you did have, and we all do, we have all got some pre-existing views and prejudices maybe, and when facts emerge or change that undermine those, for God's sake, change your mind, right? Like, get out. There's no ego shouldn't play a part in this, and we're all going to be wrong on what our expectations are from time to time. But when, again, not having to have a different forecast, but when the facts now reveal that to be a flawed assumption, rethink things very, very, very carefully.
You could almost say that you should build your argument as sort of a straw man to be tested.
You could say that. That was not intentional, by the way.
No, that's good. That's good. That's even better. Yeah. So did you want to talk?
Let's talk some stocks. And look, partly this is because I know we've both had a long association with this company, and it's done very well recently. And hey, it wouldn't be the internet if we didn't pat ourselves on the back and do a bit of a victory lap. But I think beyond that, I think there's a lot of really great lessons here. Of course, I'm talking about PushPay. It's a company you actually put me first onto, I want to say, would have been 2015, 2016?
16, 17, yeah.
2016, okay.
16, 15, yeah, anyway. Around
a long time. And this is, I think this is one of the first lessons that I would like to highlight here is that, so just for context, for those that aren't following, it's doubled in price or so in the recent past, which is great. Very happy for that. One of the popular, the most popular stocks on Strawman, my major shareholding. I know you've had a very big shareholding in it for ages too, but get rid of the notion that either of us saw this happening when it was, that we knew that this was going to come when it did come. This is one of those classic overnight success stories that's been years in the making. And for any of the winners that I've ever had in time, it's always been the story. It's actually been, when I buy it, the damn thing usually goes down for a while, then it goes sideways for like 18 months longer. But it reiterates that point that when the thesis is unbroken and in fact is being strengthened over time, then you don't have to worry about the timing, because all good things come to those that wait. So I think that's a real key lesson in that for me. What did you take away from the recent movement there?
I think that's spot on. It's been really interesting because I was actually going on TV. I was going on Ausbiz TV the other day, and I was going to talk about PushPay, and they said some other fund manager was going to talk about it 20 minutes before. So could I talk about something else? I'm like, what? Who is this? Who's this new guy jumping on? So we first recommended it at Pro, and I think the day before, I think I was talking about this the other day, there was like 0 trades on the ASX, or like just a handful of 100 shares traded or something, and one of the clients pointed it out, and thankfully there was a little bit of liquidity in New Zealand, and anyway we thankfully were able to get into the stock then. It was like $1.55 or something, and not really followed. And I think a lot of people dismissed it for the same reasons that I did initially, which is just giving for churches, how big is that market, et cetera, et cetera.
It was bleeding cash. It was losing money.
Yeah, exactly. It was losing money. All the
little Kiwi company, taking on this giant US market.
Exactly. And I think the last few years it had changed a lot. So it had been this hyper growth. It was like the fastest growing company in Asia or something when I first came across it as on one of these lists. I don't know, Forbes or something, like Asia Fast 50. And then it really changed quite quickly, where it tipped into generating cash and profits. And so that was part of the reason that I was still comfortable talking about it publicly. I don't talk too much about stocks since I left Pro, just because it's very hard when you're just talking about something that you can't give the update, right? Like if I say something positive about a company, who knows what can happen next, and I might want to change my mind. So it's just one that was quite kind of safe and steady in that kind of space, because it had started generating cash flows, and it had just such a sticky, the people, once you've moved all of your churches over to, all of your congregants over to give through PushPay, you don't want to move somewhere else. There was this natural tailwind because everyone's converting from check to online giving. But as you said, it was okay. It was doing well. It was grinding higher, and you could see a very long pathway there. But then COVID-19 came along, right? And so suddenly you have no in-person meetings of those churches for all of these large churches, and they have to switch everything. Well, either they switch to online giving or they don't get donations, basically. And so you've seen this incredible, and it was really stunning to watch the share market's reaction as well, because it sold off aggressively early in it, and the kind of reaction. Because
great example of that first order versus second order thinking, right? Because you would think 100%. People can't go to church anymore, particularly these large, evangelical gatherings where you require a huge amount of people. That's bad, right? Or is it?
Yeah, exactly. So as it turned out and the company updated, it basically, what happened is the total pie of giving shrunk. No one knows how much exactly, but there was definitely less total giving because there was no in-person. But there was just this huge shift in share, and PushPay saw a big increase in demand actually because of that increased kind of share. So it's bringing forward that adoption curve, you could say, of all the churches that are delayed making that transition across to online giving, and now they're just forced to do it. It's also been probably a push from the smaller churches that were struggling to the larger churches in terms of like kind of share of congregants, whatever you want to think about it. And it's just a fascinating example of you really need to be kind of on the ground or talking to people in that space or doing some way to track it if you want to get a lead on that, or just not overreacting. But yeah, here's a business that had no debt before this, had incredibly sticky revenue. So this was going to survive, like no doubt. It wasn't burning cash and complete, so all of those qualities were going to be rewarded anyway. I was kind of thinking at worst case, it would shake out a lot of competitors, because there are some competitors that are in worse segments, like the small church segment. Tidely is one of those that will be struggling a lot more. But then you have this on top, it's a classic case of like, once you're prepared for something, like fortune falls in your favor as well, right? So now that they're prepared,
chance favors the prepared mind.
Exactly. Yeah. And so now they've got a big opportunity, I think, and where they could really add value. And I kind of asked this when they had the analyst call, is like, what are you doing to really drive this home? Because some ways they had been a bit more conservative than I'd hoped over the last couple of years. And I think now just you have the permission from the market, like spend on something to acquire and lock in these customers. And I think they could make a really good acquisition as well. Obviously I'd written about that once before, but I think there's other church software companies that aren't going to be faring as well during this. So there was like one that I mentioned, Brushfire, which does like events for churches, and there's no in-person events anymore. And so obviously they're trying to sell like Zoom events or something, but who would use Zoom? No. But yeah, so it's kind of a harder thing to build an events business around that. But that's a great opportunity potentially for someone like PushPay to come along, who are generating a lot of cash, was it almost 50 million of US EBITDA this year? So a lot of cash, still a huge amount of borrowing capacity. Could go and buy something like that, I think. And yeah, a good opportunity to leverage that strength.
Yeah, 100%. How do you think about it now? I mean, again, you see this all the time in the share market. No one's interested in a stock, particularly regardless of how attractive the business is, if the share price is going down. It's always this fear of, well, what does everyone know that I don't know? And even before this sort of the earlier part of the sell-off this year, there was a bit of a sell-off, I want to say last year, because the founder was selling out. And so that created a bit of concern amongst people and the rest of it. But as the share price turns up, well, that's when all the interest comes. So bizarrely enough, you've got the same business that it ever was, but now at a far less attractive price, but more people are interested in it. Without sort of, revealing too much of your hand, is it less attractive? Well, I guess it is less attractive now at a higher price, but is this one that you're looking at selling down in part at least, or altogether, or how are you thinking about that valuation angle?
Yeah, I think if it was at this price before this whole thing happened, I'd probably be selling down pretty aggressively, if not out completely. The question for me is how much of this is going to stick around, I guess, afterwards. How much it brings forward a lot of demand.
Curve.
Yeah, exactly. Like if you bring forward 3 or 4 years, and actually PushPay was kind of stuck in this early adopter phase. It hadn't kind of crossed the chasm, as they talk about, with adoption into the early mainstream. So if that's happening, I think that it's undervalued here. If it doesn't happen, if it's just a blip and they go back to not kind of struggling to get into that mass market, then it's probably a bit overvalued. They've still got a good run in the meantime. There's just a lot of optionality with the business though. So I still think it's a pretty interesting spot. I'd say that I'm still kind of trying to, do a bit more research on it and figure out which way I want to lie. But I think they've got a very solid base under them. They've got a clear kind of tailwind right now that's being accelerated. I think if they made some really smart acquisitions to kind of, press home the advantage, or if they could do something else with marketing to press it home and lock it in, it could be very undervalued basically right now. So yeah, a bit covering bases, but I'd say like leaning towards being pretty interesting at the moment.
Yeah. I'm struggling with it as well. I actually got to just do the work and sort of dust off the spreadsheet, so to speak, and have a close look at it. I know that when you're, look, if we were talking about Telstra or something like that, you know, your valuations have to be super spot on if you want to do well on it, you know. But for a very fast growing company, one that's passing I know you're fond of fundamental inflection points, you know, where the bottom line can grow at a much greater pace than the top line. It's something where there's just that future skew of possibilities is quite wide. And if there's one thing that's painful in investing, it's not so much the loss that you make, it's selling out of the monster stock, as you might call it, way too early, even if it was at a great profit. I mentioned to you the other day, I sold out of Xero at $17 a few years ago. Did quite well, thank you very much. But the opportunity cost on that decision was ridiculous. And I think when you've got a company, as you say, with all the, I won't repeat them, but all the lovely attributes that they've got and all the optionality, I probably do think it's on the more expensive side of things now. And I'm actually considering selling down a little bit, largely for portfolio management purposes. But I don't want to get too granular and specific on a valuation here when I know that the upside is still massive for these guys.
Yeah, I think that's the way to think about it. Trying to think about it in terms of trimming instead of selling out. There's just way too much bias towards selling out for some reason. I think if something's grown and everything's executing really well and the share price has gone up, most of the time if your decision there is to sell out completely as your first decision, it's not driven by really analyzing the business. It's because you're afraid of losing those gains, right? Like you don't want to, you'll feel stupid if you lose. Exactly. Yeah. So I think that's a smarter way to do it. Have some idea of what you think it's worth and then like trim down if it gets too far above that. And, you know, as we've talked about many times, I'd like to have some buffer because our valuations are just kind of one point in this cloud, as we were talking about earlier, of different possibilities, to give some kind of value to that optionality upside. So if it's ticking a little bit above your intrinsic value estimate and you haven't baked in the fact that they could make a really important acquisition, or you haven't baked in the fact that these customers could stick around for the future and you could bring forward that whole adoption curve, maybe that would be an okay time to, you know, continue to hold. And yeah, just as you say, portfolio management is the other kind of main reason to look to trim some. So yeah, it's very interesting times.
Yeah, man, we could talk PushPay all day long and other stocks as well. We won't though. But I did want to say, by the way, big congrats on the launch of Maven. Very exciting times.
Yeah, thanks very much. So yeah, we're open for applications now. Those are closing on June 1st, so we'll be launching on June 1st.
2 weeks.
Yeah. And yeah, 2 weeks. 2 weeks from the time we're recording. I'm not sure when you'll be releasing this, but could be less by then. Yeah, it's been really exciting. A lot of time building structure that we're keen to get started. So yeah,
that's awesome, man. I'm really keen to sort of track the progress. I know you've got pretty much all of your own capital in that. It is something that is way too uncommon in the funds management business, and I know you've got a pretty good track record there too. So I wish you all the best of luck. It's super exciting, and also launching in a very interesting time as well. So I'm sure you've got a bunch of opportunities lined up. So yeah, congrats with it all, and be watching very closely.
Yeah, awesome. No, thanks very much. Yeah, so if anyone wanted to check us out, we're at mavenfunds.com.au. But yeah, Andrew, I think we were chatting before and we didn't mention this, but you've had a pretty killer week for Strawman as well.
While we're patting each other on the back.
What was the latest stat?
Yeah, so we launched a new version in April. So we put virtual portfolios on. Strawman something that's been in development for way too long. But we're getting to the pointy end of it where things are really starting to come together. So we've seen a huge lift in traction there, which is really great. In fact, in the last week alone, I think we're going to be getting close to about 600-700 new people signed up, and we've got 8,000 people that have joined Strawman since we've launched.
Wow, it's
which
big,
I'm
man.
super excited about. And it's still not finished. So we've got some
pretty much every time we talk, you're planning something new, which is cool.
I'm doing everything that they tell you to do with startups. I'm doing it wrong. So you know, everything's always a month away, and like, you know, perfect is the enemy of good. But you know, yeah, I'm pretty passionate on making it the best it can be. And there's some really cool, in fact, this week, hopefully some big enhancements that are going to come along to that. So, yeah, super psyched, and yeah, I think we're in a good position to finally offer Australian private investors a decent forum to sort of get together and chat without all the hype and noise and pumping and rubbish that you get on other platforms. So I'm pretty psyched about it.
Yeah, that's awesome, man. Yeah, I think it's a very good forum. As I've said before, I check it when I'm doing research in any company. So it's part of my process now. So yeah, cool. definitely build a much higher quality group, and yeah, just need to keep getting the word out. And I mean, 8,000 was it 700 last week. So sounds like you kind of are.
No paid advertising for that either, which is really great. So it's like a lot of companies that we invest in. You know, you like to sort of see a bit of a network effect and a bit of sort of that positive flywheel. So it's taken a while to get there, but it's starting to get there, and it's really exciting. So yeah, man, we should do this again. I should be clear, this is not a regular thing, it's not a formal thing, it's a really ad hoc, let's just record our conversation, but we should do it again at some point. Yeah. Stay in touch.
Sounds good.
And if anyone wants to catch up, you know where to go. And thanks for listening to us crap on for a little bit. We hope you've enjoyed it, and we'll talk to you again soon.
Awesome. Thanks very much.
Cheers.